8 o'clock on the dot. Welcome to class, Jason. Welcome to class. Jason, welcome to class.
Oh, your laptop.
Laptop, phone's going, laptop, you know. So Tuesday I went with my nephew. My nephew starts at FIU in January. So I played dad. I went to the parent orientation. So I stayed there for like a little bit, you know, and I figured out that the only parents that were there were like the helicopter moms that, you know, and like I said, like, you know what, he's got to figure it out on his own. So I left. But what was very interesting, the orientation, there were probably 300-400 kids that start now in the spring. And while they're waiting for the thing to start, so they tell you to get there at 8, and the thing didn't start till 8:30. And I got there at 7:30. So, but all the kids are in this auditorium, and what do you think every one of the kids is doing?
On their phone.
On their phone, looking down.
Yep.
You know, they had material to read, they had people next to them that they could speak with. They're on their phone, living in their own little private Idaho. So.
You know that now there is something that they thought a new generation, like malformation. They make like, if you're all the time looking down, now people having problems with their
neck.
cervical. Mm-hmm.
What was the thing that I saw that it's up in heaven and somebody's like some saint or something, or some angels talking to St. Peter, and St. Peter says, "So how's it going? How's it going with the new recruits up here?" You know, he says, "Goes okay. I mean, we get a whole boatload every day." He goes, "But they seem very discontent." And he said, "Why?" And he goes, "Well, they all seem to be looking at their hands with a blank stare." You know, it's like one of these cartoons. It's kind of a graphic, and you see people kind of hunched over like this. So anyway, so today we're going to deal with chapters 21, 25, 27, and 28, which have to do with. We should take a picture of this, dude. This is like.
Wow, things like Captain America.
You gotta go in front of the camera.
No, I have to see it right afterwards. So.
No, I just thought with the shades and all that, it was like a. So chapters 21, 25, 27, 28, which deal with Treasury and agency securities, residential mortgages, and securitization. So that's kind of the general topic of the conversation today. We'll talk about some collateral situations related to that. We also have 3 presentations, and they're quite extensive. And so what I will try to do is to blow through the textbook lecture quickly so that we've got plenty of time for the presentations. Subsequent to that, if time permits, I have a whole bunch of material that I typically present in this class that I've not been able to do, related to historical returns of, for example, public equity, geographic returns, public versus private equity returns, and I go through a whole presentation on styles of investing, value, core, and opportunity, and how that all plays into the whole sort of quadrant and the return expectation and the risk reward profile of different facets. I don't know if we'll have the time to do that, and if not, I apologize. It's something I spend a lot of time preparing every year.
Can you record that for us?
I might be able to. Maybe that's a good thought. It's a good thought. Maybe I can do that on the Citrix platform, on the GoToMeeting platform, and have it for posterity's sake. Maybe that's a thought.
Yeah, because that sounds like good.
It is. It is. It's very interesting. Very, very interesting. And then if time permits, we'll do a little prep for the exam. We'll do the exam in class next week, in class. So come prepared. 40th birthday and all other things aside. Celebrate after.
That's the only thing we're doing next Saturday.
Next class, you will have 4 hours in class. You will have 4 hours. You will have 3 hours and 45 minutes. You will have 15 minutes in class to do. And let's say this, if you're watching this, if you are not on time, next Saturday you will not be able to take the test because we cannot change this. Yes?
I'm just letting him know that his birthday falls on the Dia San Lazo. December 17th.
Okay.
The Dia de San Lazo.
Okay, dude. Dude.
Keep it safe.
Dude. Okay, if you do not come on time, Erica, you just walked in front of me.
Sorry.
If you do not come in on time next Saturday, you cannot take the final. You cannot, because we need to do our evaluations in advance, and then you'll have 3 hours and 45 minutes exactly exactly to do the fire. Everyone's been warned, right? I should be, I'm preaching to the choir. Well, I'm preaching to the choir, because you guys are always on time. Okay, so.
And that's the one day we're not gonna be on time, right?
Oh,
Ben?
yeah.
That's Murphy's Law, you know
On
that.
time every week, man. Let's just say this
Until the
week's gonna
kids-
be a little hectic.
If you're early, you're on time. If you're on time, you're late, and if you're late, don't bother coming.
Oh my God, no, I have to come here overnight and camp out.
Stop on site.
Okay, so, I will try to bypass some of what the lecture material is, only to defer to part of what Danilo has done, because he's taken his presentation a little bit further than just a topic, which is good, which is okay, it's okay. So, why don't we talk about treasury markets? This short breath. Yes, are you raising your hand, or are you just eating finely, like, with your pinky up?
She has class.
I didn't know she was like, she's like.
Yeah, class.
We'll talk about the importance, the treasuries also have a very important role as it relates to commercial real estate loans and a whole sort of call protection. We'll talk about that in a little bit. Talk a little bit about mortgages. So we talked about debt conceptually already before. We've already gone through debt instruments, debt markets. Specifically here, we're talking more about mortgages, because mortgage, especially as it relates to real estate, is we talked about real estate being about 70% levered. So just, critical. And rather than doing REITs typically have an ability to issue unsecured debt or just general corporate obligations and debentures and all that. But most real estate in this country, as we know, is privately held. We know that that's the biggest chunk of the quadrant. The biggest chunk of the equity quadrant, and much more private than public. And in the private realm, the typical debt structure that you see is mortgage as opposed to any kind of unsecured. So we'll talk about specifically the whole concept of prepayment, and we'll talk about call protection, how lenders protect themselves to prepayment risk as it relates to that. And then we'll talk about securitization. We'll talk about asset-backed securities. We'll talk about how asset class securities work. Danilo, please put it away. Thank you. How the whole securitization process works. And I'm not going to spend hours on that. I'll do a sort of basic top-level flow so you see how pass-through securities work. And then we can expand it if you think it's worthwhile to do so, and if time permits. Okay. We'll talk a little bit about the differences that exist between a commercial and a residential mortgages, their realm. Okay, how that all sorts out. So, yep. Any questions? Anything that people would like to cover? Specific, Ben, any questions related to the reading material that you have? No. Danilo, Erica, Hugh.
I will say, current events. There's an article in the journal about all these high-level cabinet positions and the tax advantage that they get, right? Because they have to sell certain assets, so they avoid this conflict of interest. And there's, I guess, a provision that allows these people to not pay taxes on these, since they're in essence taking a job and they make so much money.
Yeah.
Well, it's not that; it's that they make so much money that they would never want this job because of the tax implications that they're going to have to face by selling their assets. So the article basically said that people are going to save, hundreds of millions in taxes by by selling their assets or whatever they have to do to avoid conflicts of interest.
So, listen, that's interesting. I didn't read that, but
Yeah.
that's.
But in yesterday's
It's
journal.
not on the quiz.
No.
No, it'll be on the next quiz.
But
There is no more.
I think what we all lament typically is that we can't get good people to go into government.
Yep.
And so, at a certain point, we have to create the proper incentive for people to, one of the big problems that happens in Europe today with all the governments is people are professional politicians in many countries, which means their job is working for a party. And parties need to finance themselves because they have to pay salaries to. So, in this country, people sort of run for office in theory for public good. Now, whether there's some hidden benefits, direct or indirect, or bribes or kickbacks, or but there is a sort of general good that people do. But, in Europe, you all of a sudden have all these people that just, it's their livelihood, they're professional politicians. And, then you get into the whole conflict of how do the parties finance themselves, right? How can they finance themselves legally? They can only finance themselves by winning influence, and so it's not easy, but I would tell you if we want good people in government, we need to create incentives in order for them to do so. And
Yeah, then an example of the former, I guess, Treasury under Bush, Henry Paulson. I guess he was an executive at Goldman Sachs. They estimated that he might have saved anywhere up to about $200 million in taxes.
That's a lot of money.
And he's the one who technically bailed out Wall Street, technically.
yeah, well, listen, I don't want to be. I had a friend of mine who's, very sort of like grew up in the 60s, he like played in a rock and roll band from when he was like 14 years old. Long hair, recovered addict who like became a PhD in psychology. It's a great, but he's been writing these long things every day about, the takeover of the US by Wall Street the last few days. And I go, Dr. Pat, dude, chill, dude, just like play your guitar, have a beer, No, man. No, man. No, so, no, well, I was trying to think where I read it, but I read it. I think I go to this website every morning, do a reflection, and the gospel reading today at the end, it talks about going out and serving the world and all that. And it says you have received without pay, you should serve without pay. So yeah, it would be nice if people would just serve for their good and be willing to pay all these taxes and all that. But at a certain point, no,
with it. I just thought it was
no, it's interesting.
I mean, kind of like you said, you want to attract, qualified people, good people that, that may.
And you definitely don't want to put them in a position of conflict. I mean, that's a problem.
Yeah, and you don't want to punish them for accepting a position that they could help in by making them sell their assets and pay $100 million in
Right,
taxes.
that's why you put that in a blind trust, man.
Well,
I don't know about all that.
Dump it in a blind trust.
Well, listen, I'll read the article because I want to understand. I mean, that seems.
If he's gonna pay 200 million in taxes, he's not gonna take that job.
So, anyway, listen, let's go back. I'd love to talk about, there's a lot of stuff going on, but I gotta get through this material because you will be tested on it. And since you will be tested, I want to make sure that at least I've covered some of it up. The one sort of basic backdrop that I'll tell you, Treasury notes, the one sort of unique thing that they have is that they are backed by the full faith, right, of the U.S. government, right? They are backed, full faith and credit of the U.S. government. So what does that mean? What does that mean? It means you're going to get, at least historically up to now, it means you're going to get paid back. It's not like the guy that you owe money to. You may get paid back, you may not. You may have recourse. But in theory, up to now, we've gone under the basis that the U.S. government will always pay you back. Okay? And we know why, right? Because the U.S. government can do what? We've said this like 3 times, right? What?
They can raise taxes.
They can borrow again. They can borrow, which is, a lot of what they do is they borrow to repay the debt that comes due. So, debt expires, matures, they issue additional debt, and with the proceeds, pay what they have. So that's one thing. So they can borrow, they can raise taxes, and in theory, you can print money.
Right.
You could just turn on the machine. Now there's different ways to create money.
Quantitative easing. Quantitative easing.
You can create money in a variety of different ways, right? That's, this whole quantitative easing is an indirect way of financing the deficits. You're buying your own debt, so you're kind of like just turning the machines on, right? If this pocket is loaning to this pocket, you haven't created any wealth or really transferred a whole lot,
If we're at 20 trillion debt, at what point it becomes, it begins to affect the credit rating of the U.S.?
It already has. I mean, the U.S. doesn't have AAA credit rating anymore. I mean, it was downgraded some years ago already.
About 4 years ago.
4 or 5 years ago, something like that. So, the way I summarize it is that the treasuries have essentially no credit risk. Now, there may be some credit risk, it's not AAA anymore, but essentially, but it is also important, to track the treasury markets, because more so than any other sort of debt market out there, it is very deep, right? Very broad, and relatively transparent. We can do a lot of things with the treasury markets, but for example, we've got $20 trillion in federal debt. That already gives us a tremendous breadth of transactions to draw information from. We can draw the yield curve, we can talk about the term structure of interest rates, right? We can do that on an inflation adjusted basis, okay? And we can do a lot of different things, because at the end of the day, you know, the Treasury offers debt in a variety of different fashions, okay? And we'll talk about all those now. Interest income is typically taxable. So interest on treasuries is typically taxable at a federal level and typically exempt at a state level if you live in a state with state income taxes, which is the converse. We've talked about that. State obligations are typically, municipal obligations are typically exempt from federal income taxes, but taxable in the jurisdiction in which.
Can you repeat that?
Federally issued debt, treasury debt, is typically taxable at a federal level and typically not taxable at a state level if you live in a state or a jurisdiction with income taxes. And the converse is typically true. Municipal or state issued debt is typically exempt from federal income taxes, but typically taxable in a jurisdiction in which they are offered or issued. As I said, the Treasury provides, or the Treasury issues debt in a variety of different ways, and different fashions. One of the ways that we can disclose that or break that down is to talk about the maturity. And on the maturity, we typically talk about three different sort of levels. We talk about bills, we talk about notes, and we talk about bonds. Okay, and bills typically have a maturity of less than
2 years?
Yep. Notes are from between greater than 2 and less than
5?
10. And bonds, we typically talk about 10 plus. Okay, now, you don't see a lot of 2s, but you see a lot of 90, right? You see a lot of 1 year, right? You see a lot of, 5 year and 10 year, and then 20 and 30 year, okay? The Treasury also issues, another way to talk about it is the Treasury also issues TIPS. What are TIPS?
Treasury, inflation protected
Securities.
Yeah.
Okay, so basically what they're doing is they're fixing a rate, right? And then you're adding to that an inflation component, okay? So both the principal is adjusted essentially, and so your coupon is going to vary as well. So what you do is your coupon is whatever the fixed rate is plus the inflation component. But the way that works is you have your original principal, right? And you inflation index that, and then you apply the fixed interest to it. So your coupon is growing with inflation, and your ultimate future value is going to also go up by the impact of inflation.
We can use TIPS as a benchmark, right, for real estate investments. At least the minimum, to that we add the risk for real estate.
Well, you could use the TIPS, but you could also use the regular non-inflation protected securities as well. Because real estate is affected by inflation, right? So if you want to really benchmark, I would benchmark. So you can benchmark against anything you want, but I would benchmark against just a typical, straightforward, say 10-year Treasury, and talk about spreads in relation to that. If you want to have that same framework versus a 10-year TIPS, that's okay too, but you can index against any, or benchmark against any index you want, as long as you maintain consistency from period to period.
Right, but if you use the inflation protector and you at least getting rid of the risk of inflation with a tip.
Well, you are, but you're talking about comparing it to real estate, and when we talk about spreads in real estate.
But what I'm saying is, if you're going to invest in something real estate, at least you want to make
Oh, so
more
okay. So you're not talking about benchmarking.
Yeah, as a minimum. to use it as a minimum,
Yeah, I mean,
as a hurdle, well, not a hurdle, but.
right, so I mean, listen, we could use a theory that we've already discussed about what, the return to debt, right? Now, real estate investments is not investing in debt. You can invest in a debt of real estate, or you can invest in companies that invest in debt of real estate, but, your expected return in that concept, yeah, should definitely be your risk-free return, right? Plus some sort of inflation component, right? Plus some sort of risk premium, right? Plus then some sort of plus or minus premium for callability, convertibility,
Right.
liquidity, right? Marketability, taxability, etc., right? So there's no doubt that, you could use this, so your expected return in real estate should equal some sort of risk-free return. If you want to use tips as that's fine. You got to add inflation to it. Now you can use,
Tip for that, right?
hold on, but you can add just a 10-year treasury here, right? And in theory, you've got this already, and then add your risk premium to it. That's why I'm telling you, from a benchmark perspective, I've usually just seen the uninflation index, straightforward 10-year treasury.
Okay.
Okay? Up to now, treasury markets have typically been institutional in nature. Okay, there's starting to be some movements towards, some sort of trading. You can buy them now. You can sign up on a government website and actually buy on an individual basis treasuries. Okay, obviously these things are not sort of return driven, and at the end of the day, you can't. They're really over the counter instruments, and so there's no real exchange. And there's a whole sort of movement to modernize the credit markets that way, but they're sold through primary dealers. I forget the number now, but there's X number of dealers that deal or that trade in government debt, 30, 40, something like that, and then those dealers turn around and sell it. But it's all institutional in nature. We're talking about, large denominated, notes. There is a secondary market, okay, but again, institutional in nature and over the counter. So, banks to one another, investment banks, bond dealers to one another. But that's all a whole sort of still a sort of old boy network, people calling and moving that around. So last week we talked about the equity markets, and we talked about all these different trading techniques and stops and margin trading and all that. But that really doesn't exist especially in the treasury markets, okay? We talked the other day about innovation in the capital markets. One of the things that I should have used as an example is what are called strips. Does anybody know what strips are? Separately traded, separate trading of registered interest and principal securities, okay? What strips are is you take somebody, I think this was Merrill Lynch back in the 80s or something. If you were to take a 10-year treasury, just for argument's sakes, right? So you put out, let's say, $1,000 at the beginning, right? You loan $1,000 to the government. And let's just say that it's a 5% note, right? Twice a year, they're going to pay you $50, right? All the way down, and in year 10, they're going to pay you what? $1,050 on the last one, right? Because they're going to pay you the last interest payment plus the principal, right? So you can buy this security as a whole. Well, somewhere along the way, somebody said, hey, what if I only need $50 here? Or what if I only need $1,000 here, and I don't need all this interest? So they came up and said, we're going to strip this. We're going to strip this. So they kind of made the moniker first in a separate trading of registered interest and principal security. And what basically they did is they made that strip a security, and they made this strip a security, and they made this strip a security, and they took this security and made it 21 different strips. So there's basically 21 separate securities here. And when we were talking the other day about the preferred habitat theory in interest rates, right? We talked about how people were looking, it was this whole unrelated thing. We were saying people want to live in different parts. People have different financial needs. And this kind of corresponds to the fact that people have different cash flow requirements. And so that's what strips are. Now we'll talk about how we use that a little later in the class, okay? But that's kind of a very important concept in real estate today. Now, I don't know why you would want to, but you can actually also reconstitute a strip. So that's a whole other innovation thing. So you can actually buy all these strips and kind of make a bond out of it. But I don't know why people would do that. But
Why is that important in real estate?
strips? Stay tuned. Bless you. There's a series of quasi-governmental type entities out there whose debt mirrors that of the Treasury. I'm not going to spend a lot of time on it. There's entities like the Tennessee Valley Authority, the Federal Home Loan Banking System, the Farm Loan Banking System, and then the big ones we know in real estate are Fannie Mae and Freddie Mac, right? So the people that ultimately provided the liquidity for the secondary mortgages in the market, or liquidity, a secondary market and liquidity for mortgages. All right. So these are all either fully government owned or what are called GSEs, government sponsored entities. Okay. Now we've talked about Freddie Mac and Fannie Mae. Those are not government owned today per se, but there's a subsidiary, an entity that was created by the U.S. Treasury that owns 90% of the preferred stock and has a conversion feature on it. So they de facto own it. And so that's kind of passed from being a government-sponsored entity where there was kind of like this sort of implicit U.S. government guarantee of its debt, to I think almost saying, hey, there is an explicit. And in fact, when it all went down, the government stepped in and funded all the losses of these two entities. So these entities are like government. When I showed you the credit risk profile, they have a slight premium to treasuries, but it's almost like the full faith and credit of the U.S. government. Okay.
Which one is Ginnie Mae?
Ginnie Mae is a separate entity, and Ginnie Mae has kind of a double guarantee. And I'm not an expert in the mortgage market, but Ginnie Mae Ginnie Mae is an entity that buys mortgages and then packages and resells them to investors of VA and FHA guaranteed loans. And so what happens is they buy all these loans, right? So they create liquidity, they create a secondary market, they package them. We'll talk about how that all works in a second. And then they sell pass-through instruments. So, because Ginnie Mae is actually is a GSC, there was never any sort of separate private ownership of that. Fannie and Freddie were publicly traded, which is kind of an unfair advantage because they were companies whose shareholders benefited from the activities of the company, but the sort of credit risk had been kind of taken away from them, theoretically, by this sort of implicit U.S. government guarantee. Ginnie's always been a U.S. government-owned entity. I don't know which branch of the government owns it. I'm assuming it's somewhere under HUD, but it might be in Treasury. I don't know. That's something we can look up. But so then what happens is the Ginnie Mae pass-through certificates that are sold not only have the implicit government guarantee because they're issued by a governmental entity, but what backstops those are all mortgages that are guaranteed by other government branches. So you kind of got a double guarantee there. So I mean that's pretty sort of bulletproof.
Sound pretty safe.
Yeah, it all goes back to the U.S. government though. So I mean different branches, but it all goes back to the U.S. government. Okay, so that's.
Why do they have these names, Fannie, Sally?
Dude, I remember I did a project downtown about 10, 12 years ago. There was a big ministerial meeting. They were trying to do this free trade agreement of the Americas, and it was the 10th anniversary. So in 1994, Bill Clinton signed an agreement with like 30 presidents of the Americas, and there was going to be this whole free trade agreement in the Americas. And in the 10th, it was supposed to be negotiated over a 10-year period, and in the 10th year it was supposed to be signed. In the 10th year, there was a ministerial meeting every year. It was held in Miami. It was going to be held in Miami, just like they had signed this thing in Miami at Vizcaya, and in this 10th year it was supposed to come together. So it was this big to-do. I don't know if you guys remember, there were like all these, downtown was closed, and there were people like Chief Timony was out there on his bicycle, like beating up protesters and stuff like that. And anyway, I spent 6 months working on that downtown. I had my job, but my boss volunteered me to go help. So I worked at City Hall, and I still, at night I'd go back to the office and do stuff. So anyway, there was a guy that the mayor of Miami had loaned to work with the effort, and he said, he's kind of a funny kid, kind of dry sense of humor, and he said, look, if you ever want government money for something, just come up with some sort of acronym, and I forgot, he was like, like Cuban American for the propagation of whatever, energy, so just your CAPE. So why do they use Fanny? You just got to come up with, monikers or acronyms that people can relate to, or. He just said, if you come up with something like that and then you just find a politician, you'll get money. So, I don't know if that's true or not. All right. Let's talk a little bit about residential mortgages, and then we'll talk about commercial mortgages, and we'll talk about the distinctions or the differences between them. So, again, everything in this class is evolving, and in fact, even this morning, there was I didn't have time to read it, I saw the headline. There was a whole, I started reading the article, I didn't have the time. There was this whole thing in the Wall Street Journal this morning about the whole shadow banking system, and we've seen how I think the lion's share of mortgages, or at least a majority of mortgages in this country now, are no longer being originated by banks. So the whole there's been a whole sort of disintermediation, process, right? It's evolving. It's evolving, and I don't know how that all ends up, but historically, and I think I can talk about the historical sort of flow so that we can understand what at least the flow is. Historically, banks would take deposits, right? So commercial banks would take deposits and make loans, right? We've said that's what the business of a commercial bank is. And especially as it relates to S&Ls and community banks, what was very typical was to take deposits and make residential mortgages. And so banks historically were the single largest sort of mortgage originators out there. Now, evolution in mortgage banking industry came up. And so mortgage bankers are different than commercial banks in that mortgage bankers do not take deposits. Okay, so their liabilities are not deposits. They essentially take wholesale bank loans, right? So their balance sheet is, so a mortgage banker's balance sheet kind of looks like this. A mortgage banker will go and get a large credit facility from a commercial bank or some other shadow financial institution, and then they'll originate a whole bunch of mortgages, right? And then we'll talk about, then they'll turn around and sell those to somebody who's going to hold them, pay off the loan, and start all over again. So the mortgage banking business strictly is not a commercial banking business. It's not taking deposits to make loans. It's borrowing money to make loans, to sell them to whoever's going to hold them, to then do it all over again. Okay, now, once upon a time, these mortgage banking operations resided within commercial banks. So it was a subsidiary that borrowed from the bank, and then maybe they would sell some of the mortgages to their bank, maybe some to third parties, whatever. But then sort of standalone mortgage bankers, or the mortgage banking business, evolved. All right, so there's no sort of long-term nature to this. It's in and out, in and out, in and out. You're making a little bit of money, and a lot of these mortgage banking operations also survive with fees, right? So you charge fees.
Origination fees.
And then a lot of times they do service the loans for people. So, you know, the guy you think I went to SunTrust and they gave me the loan. Well, maybe SunTrust never owned it, you know, it's just their origination business, like their mortgage banking subsidiary. And those loans reside somewhere, but I keep making my payment to SunTrust.
Right.
And then they distribute it to whoever, so, you know, they'll make little pennies for that, and they'll hold the escrows and make a little bit of money on that, and whatever, okay?
Putting mortgage banking aside, what other type of bank, besides commercial banks, are there?
As mortgage bankers,
No, just as any type of bank. What would be another bank? I mean, we're talking about commercial banks. I thought all banks were commercial. That's what I'm thinking.
well, remember we made a distinction when we talked about the Glass-Steagall Act between commercial banking, investment banking, and insurance operations, okay? And we said commercial banks basically did two things. They take deposits
And they
and make loans. Okay, that's kind of their basic business. And last week, we went over investment banking firms, right? And we identified a series of things that they did as the nature. They were broker-dealers, they were asset managers, they were financial innovators, they were underwriters, okay? They were merchant bankers, where they invest or put at risk their own capital. And we very briefly described insurance companies in the first class, in which we said they assumed risks in exchange for a premium, okay? So slightly different. So that's kind of what the traditional banking operations are in this country, right? I introduced today a new concept, which is a mortgage banker, which is neither of these two. They don't take deposits, but they do make loans. So they borrow money to make loans, all on a short-term basis. When you underwrite a mortgage, when you look at a mortgage, there's two, we've talked about this in the past, there are two big, especially on the residential side, there are two sort of ratios that are critical here. There's a payment to interest, or payment to income. So I want to call a debt service coverage ratio in the commercial realm, right? And a loan to value. So, you know, the historical kind of benchmarks here, I forget, it was historically, that's all sort of changed, right? So people underwrote this on a variety of different things. They look at your FICO scores, right? So they look at what your credit history is. But typically they would loan you money on 33% of your gross, I'm sorry.
33 and a third.
Yeah, so roughly a third of your gross, or 25% of your net, or was it the other way around? No, that's the way it is. So 33% of your growth? No.
28.
28, 35.
It's
No, what I'm saying is,
It's 33 and 28.
well, okay, or 28, whatever, okay. But basically, they would say, hey, you can dedicate a third of your net or a quarter of your gross income to service debt. So there's a concept here of how much free cash flow do you have every month in order to service the debt that you're going to assume. The other thing that they look at is how much risk, or how much risk you are, how much risk they are, how much skin do you have in the game, right? So again, very, very historically in this country, mortgages were sort of underwritten under a traditional 80-20 module, where borrowers were asked to put at least 20% of the cost of the home into the deal, and banks would assume up to 80%. And then, that all changed, right? So from that we had
80-20 piggy.
well, then there were private companies that came in there and started issuing credit risk. You pay a premium, and they would assume the default risk, right? And then, we'll talk about some of the other iterations that came, in a second, okay? When you originate loans, when you're the mortgage banker, right? There's two concepts that you can take a look at it. So you can originate to hold, or you can originate to sell, right? And I just defined, for the most part, mortgage bankers are going to originate to sell. Okay, now commercial banks, or commercial banks to the extent that they have mortgage banking operations may originate to hold. But again, as the world has turned and changed, most commercial banks are no longer really holding loans. So the whole concept of originating to hold is kind of morphed into a fee business where you're originating to sell mortgages, okay? Now, you can also then, there are, it's the whole conduit concept we'll talk about, where you can originate to hold, but really not to hold, but to ultimately sell financial instruments, and we'll talk about that later as we move as we move out. Okay, when you are a mortgage banker, there are a couple of sort of risks that you assume based on movements of interest rate. Okay, and one of it is called pipeline risk, and the other one is called fallout risk. Okay, so pipeline and fallout. Okay. Okay. And so your pipeline risk you got people committed, right? You've committed a loan, right? You've committed a loan to somebody, right? And now when you go get your funding, your interest rate's going up. Now you've got a negative spread here potentially, right? You've underwritten assuming a certain interest rate structure, and all of a sudden you get caught short. Why do you think most mortgage bankers want to hold off as long as they can to give you a commitment? So if you're a borrower, what do you want? Tell me now. What
I want a lock.
I want lock me in. I want to know. And what do these people say? Oh yeah. We're gonna get to it. Because they don't want this pipeline risk, right? Because this stuff is moving every day. I know not everybody can do what you do. Okay, these guys are doing this every day, and they're working in like thousands. They're working in little bips, little basis points. Okay, and so that pipeline risk is what their cost of funds is versus what they're committing. So they're going to want to try to match these dates as closely as possible. Yes, Kwesi?
So their cost of funds is not fixed.
Typically, short-term debt is variable in nature, and most of these things are sort of revolving lines, or they may not revolve, but they're going to be tied to some sort of index. So their funding is going to change daily.
Yeah.
But most of the loans that they're going to originate are not necessarily, and they're not going to buy and sell necessarily the same day either. Okay, so again, theoretical, that they may be able to get some fixed rate funding, right? They may already have something prepackaged to sell they may have already structured a security to sell, and they already know their exit, okay? But maybe they don't. There's all sorts of different models in this business, okay? And then fallout risk. So the other side, fallout risk is slightly different, right? So rates are going up, right? And all of a sudden, the mortgage banker sort of is in the hook. What happens if you issue a commitment and interest rates go down? You got a lock, right? But interest rates went down. What happens?
You pay a high interest rate.
No, dude, you go to somebody else and get another. You go to somebody else and get another loan. So now they've gone through all the process, they've gone through all the work, they think they've got something they could sell, right? And you fall out because rates went down. Okay, so those are sort of the two sort of inherent risks that exist in the mortgage banking industry as it relates to movements in interest rates. Yes, ma'am.
Even in real estate, like residential real estate, after, let's say that you have a contract and it's like 45 days, whatever, if you start, working with a broker, with a mortgage, you start doing the loan, it's not like, okay, after you're halfway there, you need to close in probably 10 days and you need a commitment letter. It's not like you can just go to somebody else and start the process all over.
Well, I haven't bought a house in a while, but I can tell you I always worked with like a couple of people. I never locked myself to one funding source. Now again, maybe that's changed. I'm getting old. I haven't bought a house in a while.
You have money committed to that individual mortgage banker or mortgage broker, whatever you
What,
Yeah,
what do you pay, what are you gonna pay one of these
yeah,
guys?
some companies have application fees.
Yeah, what are you gonna pay, how much?
$100, $50.
$100, okay, I'll pay $200 and I got 2 people working on it. Okay, I mean, I hear you.
Yeah, but if they're going
You
at the same,
damage your
if they're going
credit
at the same
also.
rate, if they're going at the same rate working on the loan, basically, if one is locking you, the other one is gonna lock you, and the other one is gonna lock you. So at that time, the thing is to change, I see what she's saying,
Yeah.
to switch at the end is very,
Okay,
Cumbersome.
okay,
risky.
Your
Okay,
deposit
you may lose
great, great. Guys, I'm talking about theory here, okay? I don't really care about buying a house or whatever. I'm talking about what happens conceptually when interest rates change and you're in a business. So I don't care about somebody buying a house. I'm telling you, as a mortgage banker, you got to be careful that you've got exposure to movements in interest rates, okay? And these are things that you should consider in your business.
Right.
You may not, oh, I got such a big margin. It sounds like you need some competition. I think I'm gonna just drive around behind you and see where you go and start undercutting you a little bit because you got too fat a margin. Or maybe it's somebody else here. Don't talk too much about your business, okay? Okay, mortgage bankers, they make money, service fees obviously, interest on escrows that they hold, float earned on the mortgage payments, you know, they collect them and then they pay them out to whoever has it. I mean, it's all little sort of, and then all sorts of ancillary late fees and, you know, selling mailing lists, you know, stuff like that, okay? So,
Refinancing, all
well, it's all, refinancing is like a whole separate thing, but they just, it's like a nickel and dime business. It's kind of like property management. So you need a lot of volume. You need a lot of volume and you're making a little bit from, you know, a whole bunch of different areas.
funds will be wired for closing.
Well, that's float. That's float. So you're collecting money before you got to pay it out. You know, again, if I get $50,000 and I have it for 2 days, there's not a whole lot I can do. But if I collect 10 million and I can be making a little spread every night on that, you know, that all adds up, and I'm doing that every day, you know, $10 million at 1% over a year is what, $100,000? I'll take it. Typically, so loans can be secured, mortgages can be secured, right? They can be perfected, right? So mortgages are promissory notes that have a lien in a property. That lien can be, you know, could be a first lien, but it could also be junior, right? So it could, you know, from a priority perspective, you're granting that, you know, the person who loaned you the money either a primary interest, right, in the collateral, or a secondary or a tertiary interest, okay? So a mortgage is essentially a perfected security instrument, right? It provides collateral to the person that is loaning money to you, all right? When I was young, you used to see a lot of second and third mortgages. And the reality is today, definitely in the commercial space today, most first mortgages prohibit you from obtaining any kind of secondary financing or junior financing without, yeah, it's just noise, and you know, it's somebody else to deal with, okay? So the way most commercial mortgage instruments are written today is it's prohibited. You can go and ask for an exclusion, and there may be a time, maybe in a financial crisis or restructuring or something, where, you know, maybe somebody will, you know, will agree to that, okay? I mean, banks during, and I didn't get involved in any of this, in 2008, 2009, they started taking their first mortgages and then creating sort of A and B, you know, they had like a primary and a secondary. They split their notes into 2 separate ones. And, you know, maybe in lieu of taking over the asset, they gave some residual equity interest or participation in the B piece to the creditor, so that he would have some incentive to stay in the deal and work through it, as opposed to just giving the asset back, okay? But typically, you know, commercial deals, you don't see a secondary. And I would tell you on a residential side, I don't know where the documents, my guess would be that conforming documents don't really allow that. but it used to be that sellers a lot would provide secondary financing to homes. You know, somebody, you can't get there, you know, in lieu of a down payment, you know, you would take, or in lieu of somebody being able to get a certain amount of a first mortgage, you'd take that back, you know, and, you know, and talk about concepts called you'd wrap around, right? You'd wrap, you know, or you could wrap your mortgage around that one, you know? All right,
That's
so.
the one with really low interest rates.
Yeah, so I mean, there's, but, you know, again, I haven't seen a whole lot of that in a lot of years,
I saw an assumable loan the other day.
I'm sorry, you saw an assumable loan,
Mortgage,
residential.
residential.
I haven't
that in
seen
a long
those,
time.
when I was young, that was very common. I think all FHA loans, I don't wanna overreach, but when I'm really young, when I was like 10 or 12,
They were.
I think they were, right? They were all assumable. And then, you know, that's gone away.
Then they put in qualifying, so now you have to qualify to
Yeah.
assume, and then they just did away with it.
And then on the commercial space, typically any commercial bank loan is not gonna be assumable. Life insurance and securitized loans may be assumable, but they typically have some sort of, approval condition. And I can tell you, it is relatively doable if you've got life insurance debt, because, why is that, Ben? Why would you think it would be doable?
I don't know.
Any ideas? Because you're dealing with a person. There is somebody at the life insurance company you can deal with. If you're dealing with a securitization, who are you dealing with?
Bunch of person.
An institution?
A servicer,
Service.
who may have opposite interests than the seller has, because he may have, and typically has, some sort of interest in those notes. And so there's kind of a conflict there, that what may be in your best interest as the buyer that wants to assume may be contrary to his interest. Or,
The assumability of the life insurance, I saw a commercial on TV the other day, you know, a couple old people talking about, they didn't know that they could get money for their, policies, right?
yeah,
Is that what you're talking about? Like, how does that work? Like,
no, but the commercials you're saying is,
What's
it's like,
the
it's like
reverse
it's like an old couple and they're
an
going,
old
hey,
couple and they're saying,
and
hey.
oh, we got,
Equity.
yeah, that's, at the end of the day, I don't know how that works, but whole life insurance policies have what's called a cash surrender value. So what happens is you're paying a premium, and that premium is to go and pay a beneficiary if you croak, right? But a whole life policy in particular, part of that premium, it starts getting accumulated. So you can cash that policy in at some point for a certain value.
But how about
Hold
a term?
on.
How about a
Term-
term where somebody's
No,
pretty
term-
close to dying and can't
Hold
pay
on,
their
hold on,
bills?
hold on. We didn't spend a lot of time on that. I don't want to digress too much. So the whole life policy, a whole life policy, okay? So the whole life policy has typically a cash surrender value associated with it. So you can go to the company and say, okay, I want to liquidate this, just pay me my cash surrender value, okay? That's one thing. Now, I think that commercial that you've seen, so term, the single biggest difference between term and whole life is there is no cash surrender value. So you typically pay a much lower premium, okay? But there's no sort of value or equity accumulating with the policy, okay? People use these things more as forced savings or investment vehicles that had a benefit or survivor benefit associated with it. This strictly is a survivor benefit associated with it, okay? I think a commercial that's on TV says that you can somehow get some money from this. And I don't remember why. I saw that commercial
Yeah.
and I did some research and it seemed like a crock. It seemed like, I don't know what you could get out of this, okay? But the two big difference, or the single biggest difference between these two types of insurance policies is that there's no cash surrender value here. Now, this is not what I'm talking about at all, okay? I'm glad I jogged some memory.
But no, you were talking about assumabilities. Of
Yeah,
life
but
insurance
not,
policies.
no. Assumability of mortgage debt issued by a life insurance company. And so, That's, so what's, the life insurance companies are very rigid, you know, you talk to an underwriter or a life insurance company, they're really rigid, very conservative, right? But it's a person. In the securitizing world, sometimes, you know, you get a little better rate, right? Maybe you get better terms, but the thing you give up is that you know, that personal touch, somebody that makes a decision. I didn't print it out, I didn't have time. Yesterday I got that monthly TREP report that talks about defaults in the CMBS market, and it says that 5.3% of all CMBS loans outstanding are in default right now. Now I forget the number, but there's about just under $1 trillion of these things outstanding. So what's that, 500 million?
Is that up or down trend?
So it went up, the peak was like December of last year, and then it started to come down, and it's peaked back up above that 2015 level. And so I don't know that it's the highest it's been, but if you look back at the commercial real estate realm and the issuance of these things, there was a huge surge, right, and spike, and there are $400 billion worth of commercial real estate transactions in 2006, okay? And if these things are typically 10 years in term, right, when would the defaults be happening? When they're due now, right? 2016. So we're kind of in the trough of it right now. And why do I bring all this up? A commercial bank with that kind of default rate would be out of business, okay? Here, what are these guys doing? What are all these special servicers doing? Just punting the ball down, you know, just sort of squatting. Because, again, they don't have an REO department. It's not like a bank. They're not set up to deal with this.
Is that commercial mortgage-backed security?
Yeah. Yeah. Okay? Okay. We're still, just going back to residential for a second there. So, you know, we're talking about the evolution. We're talking about, like, you know, historically, you know, it's like you did like these 80-20 loans of people with very high FICO scores, you know, at less than 33 or 25%, you know, gross, net, right, or whatever, yeah. And then, and so, you know, we probably would have called that something like a prime loan, right? So a prime loan was a loan to somebody who was a, you know, high quality credit, right? But then, because there is a risk and reward paradigm, so people are willing to assume more risk for what appears to be a whale of a return, okay? And so somebody came up with a concept of, hey, why don't we sell these subprime loans? So what's a subprime loan?
Lower credit scores, lower LTVs,
A loan,
higher LTVs, lower
right,
credit scores.
lower credit scores,
Little blemishes.
Less,
right, so, well, anything less than prime conditions, right? Anything, and somebody said, hey, well, if we can do that,
It's secure, right?
well, they were securitizing these and these, then they said, hey,
put them together. And
let's assume more risk. Let's assume more risk.
No doubt.
And so,
Low subprime.
right, no. Well, hey, so here's the thing, right?
Oh yeah, there was a big push with alt
Alt-A loans, right?
Yeah.
Okay, so Alt-A loans, curiously, were not necessarily of lower quality prima facie than subprime loans, but they were loans that didn't necessarily have any of these conditions. I'll give you an example of what may be a loan that conceptually could be prime, but doesn't meet prime conditions. I'm a foreign national. I moved to America. Maybe my money is still gotten. Maybe it's in a fiscal paradise. Maybe it's none of that. Maybe it's just that, you know, I was working in Switzerland and I paid no income taxes and I didn't get a 1099 or a W-2 at the end of the year.
Cash in a duffel.
And I cannot substantiate my income. So all of a sudden you got a guy that you can't verify this. Or he's a commission guy and he doesn't have a fixed salary. You know, he's got some years we can demonstrate some income, but his income goes up.
Self-employed people used to get a lot.
Self-employed, so you can't substantiate, you know, the income, right? All right? And so, you know, that all sort of then it created what was that, ninja? You've heard that term, right? Ninja? No income, no jobs, you know? So it's like, oh, well, you're talking about acronyms, I just remembered, you know, you've heard all the, I haven't heard these in a while, like, DINK,
No income,
no kids, right? The one I was gonna tell you is
banana,
YUCA.
young urban Cuban American.
There you go. YUCA, Young Urban Cuban American. So I hadn't heard that one in a while. I just came.
That's you, man. That's you, man.
There you go.
That's you.
It's not just a restaurant, and it's not just a root that's called cassava in English. It's a cassava root, okay?
Actually, that restaurant in on
Alton Road.
Lincoln Road.
Lincoln Road,
It's
Yuba,
not-
it's actually that. Is for young urban Cuban American. That's the.
Make sure to go anytime, so maybe I'll see.
I forgot to mention, I just saw it in the notes here, when we were talking about payment to interest and LTV, there's a part of me, this is me personally, that would tell me that this should be the biggest indicator of default rates. That would be me, because, and I'll tell you why I would say that. I would say that because from what I've read, it appears to me that the house is the last thing that people will let go of, right? Their shelter. So you don't pay your phone bill, you don't pay your electricity, you don't pay your credit cards. You know, I don't know what sequence. You probably don't pay your credit cards first, then you probably don't pay your car next.
The car's last.
Yeah, your car's last. Now let the house go first.
Well, hold on. But your house, you need to, but what the statistics show is that LTV is actually the bigger indicator. The higher the equity that you have in the house, the more likely you're willing to fight for it. And the reason is, listen, that's what empirically, that's why,
That's true.
notice we got a guy that does this for a living.
Yeah, that is a fact.
This is, for me, intuitively, I would say this is more important, but the research indicates that this is more important, and we got a guy here saying, because as long as you got equity here, you're gonna fight for it.
Exactly.
Because you got money you can fight for. The minute there's no money there, the minute you're upside down,
What is the payment to interest? I'm sorry. What are you referring to?
no, payment to income.
To income.
So, you make $100,000 a year, okay?
And you're paying 30,000 in mortgage and.
You can pay $30,000 in mortgage or, 25, right? I mean, there's kind of this range here, right? Like 30% of your gross or 25% of your net.
If you do an FHA, you
Okay,
can go
so
45.
divide that. Now, and this is all debt, so I'm assuming, because if you've got like student loans and car loans, that has to come out of this bucket, okay? Because what people are saying is if you make that, let's just do the math really quickly.
Danielle,
Let's say you make $100,000, what are you gonna pay in taxes? Just use a number.
15.
Let's say 25 after deductions and stuff, okay? So now you're down to $75,000, okay? So what this is basically saying is let's say that you can afford to pay $30,000 in fixed payments there, right? That means you've got $45,000 with which you can feed yourself, right? Feed, insure,
Shelter.
clothe. Well, shelter is this.
Oh, okay.
Okay, so what it's basically saying is with 45, you should be able to meet all of your other life needs.
Right,
Okay.
and that becomes, the 30 becomes about 40% of your income.
I'm sorry?
That, the 40, I'm sorry, the 30,000 becomes 40% of the 75. And FHA will let you go up all the way to 45 on the front end, and then on the back end, which is all the debts included, plus the housing, you can go, I think, up to 55.
No, 45.
Well,
45.
listen,
On the
I'm,
back end?
listen, I'm out of date with what you can do. I'm just telling you, when I was young, when we didn't have all these defaults, you couldn't go to 55% of your net.
For the house.
Yeah, you could not, because
Right.
because it doesn't work. Because the reality is let's stay on this. Because the reality is, let's use median income. So you're the median family in Dade County. You make $47,000 a year.
I think that's still the case though.
Hold on, you make $47,000 a year, right? So what are you gonna pay in taxes? Let's say 7. Okay, now give me a mortgage. Give me a mortgage. Give me, what did you say, I can go to 55% of that to borrow?
No, I didn't say that. I said the
All your
back
debts.
end, that the back end is the mortgage.
Don't tell me back end, give me a number. Don't tell me front end, back end, that doesn't mean anything. Give me a number.
Big difference, it does.
Give me a number. Don't give me acronyms, give me a number.
43%. 43% of that.
I can borrow 43% of this.
Right.
Okay, so what's the number, 16, 17,000? 17.5,
Right.
right? Okay, so you're telling me, what's that, 22.5? How do I feed 4 people with that?
You can buy
You get, food
you
stamps.
can buy a duplex. You can buy a duplex for $245,000. It will cost you.
I'm assuming that whatever you bought is what you're gonna pay that 17.5. My point is how do you feed the median family of 4 with $22,000?
Because you have two incomes.
This is the median, I'm giving you a real number.
Oh, that's a household.
This is a real median income number in Dade County, okay? For a family of 4.
Household, yeah.
So what I'm saying is the real family in South Florida, forget what you can buy with this. That's a whole other discussion, okay? That's a whole other problem. Because what can you buy with that? Okay, that's a whole other problem. But my point is this doesn't work because you can't feed a family of 4 with 22,000 bucks. Feed, insure, clothe. You can't do it. That's why. But again, my point my point was way back when people were crazy and lending standards were a lot more conservative. And we didn't have the default rates that we have today. And we have the consumer debt problems that we have today. Because the other problem is, start adding student loans to this and credit cards to this, and people can't borrow on a house at all. You know what the average credit card balance in a median income or a median family in the United States is? It's like $22,000
Is the other 20?
of debt.
Is the other 22?
Well, yeah, but you're not going to pay it off in a year. Right? You're servicing, but that's $22,000 of debt you're servicing at a very high rate.
No, what I'm saying is that they have 22.
Oh, they're
and
borrowing
they
this
have
to pay for the food, right? No, but that's why I'm saying that what I believe is a degradation of lending or credit standards ultimately has implications on the credit markets in this country, okay? But anyway, so you're saying that you could borrow up to 45% of or 43% of your net.
It's more like 43. And the back end only means that it's mortgage with whatever other debts you have. The front end is just the mortgage.
So the book says the front ratio is computed by dividing the total monthly payments by the pre-tax monthly income. The back ratio is computed in a similar fashion, but it adds other payments such as auto loans and credit card, payments to it. Okay.
So you have to have like a 43, 45, or maybe something.
Loans, residential mortgages come in a variety of different fashions, right? And again, a lot of these concepts apply to just debt in general, okay? They can be fixed, right? And they can be variable, or what we typically call adjustable. So the ARMs, right? Adjustable rate mortgages, right? These things could have a fixed period, right? And again, going back to, maybe I shouldn't be editorializing in the class, I apologize, I'm editorializing in the class. Is there a problem?
What do you drink? I'm going to,
I'm good, no, thank you, I'm good.
look at you coughing so much.
Yeah, I know, 'cause I have a- but that's how, I'm good, I'm good, thank you for offering. You know, going back to, you know, when we had fixed rate mortgage, you know, way back when, you know, fixed rate, you knew what your payment was, okay? They were fully amortizing loans. You knew what the payment, you knew what you were up against, right? Now, credit markets evolved, right? There were people looking for different risks, so they started bringing capital, again, assuming additional risk, right? And providing a whole bunch of other different options, right? And so what happens with this is all of a sudden, yeah, there's a factor that says, hey, I'm a young couple, okay? I mean, I had lunch Thursday with a friend of mine. They got 2 kids, so he bought a big house a couple of years ago. They had a daughter. They got another daughter, and a month after having the other daughter, surprise, we're pregnant again, okay?
So what happened to, concept?
What happened to who?
Contraceptive.
Oh, what happened, okay,
That might be very-
I don't know, I guess, you know, let me not say anything.
It broke.
Why would someone would want to have a variable rate?
That's where I'm going. So here's a guy, all of a sudden, the house he bought 2 years ago, which he thought was gonna last him for 5 years, now he needs another room. Especially if it's a boy. So I have a friend who had 4 kids in a room, including a daughter till she was 14. You can't do that.
You can do it.
Yeah, he did it. By the way, somehow she's like the most incredible, you know, young lady, you know?
That's
Not as high as
You know, but so now he's got to go out and buy another house. But, you know, maybe he needs some breathing room, because what happens, what should be happening with your income as you become more seasoned in your career, right? You should be making more money. So an adjustable rate mortgage, or a mortgage that has, you know, negative amortization built into it, you know, over time, right? Or has no principal, zero principal payment, give you, yeah, IOs, okay? Give you breathing room.
Right.
To be able to buy here and really start paying when you're there. Now what happens? What's the danger in all this?
Property
You
values go down.
may not get there, you peter out.
Well, the thing about it is that all those plans, actually what they do is that they create more, they create more demand, because there are more people available to afford houses at those rates. Prices keep going up.
See, pero that's, you know, that's the promise. What makes you think values are always going to go up?
I'm saying that, I'm not saying that values continue to go up. I'm saying that at least for a time, because there is more affordability or availability.
Well, but that's,
of homes.
but
There are more buyers buying,
but-
demanding homes,
But the
less
point is,
supply.
but the
prices
point is,
went up.
that has been the justification for the underwriting. Because at the end of the day, when you're in the credit business, you have to assume worst case, not best case.
Right.
And a lot of these, again, non-fixed, the adjustable, you know, variety, right? The interest-only varieties.
The bigger payment variety.
Those are all, those all look at something in the future that says, hey, I can get away with a very low LTV. I can get away with a very low PTI. I can be an all day, you know, I don't quite meet all these things. I can be less than prime, right? I can originate it and sell it to somebody else. Time will not permit this wonderful presentation that I have about this whole 2008 crisis. But ultimately, it's people were issuing junk and selling it to somebody else. And one of the basic tenets of, you know, that Trump wants, everybody wants to get rid of Dodd-Franks now. Some of the stuff in Dodd-Franks tried to deal with. The problem is the government, you know, it's difficult. It can't regulate everything in life. But what they were trying to attack was this whole origination for sale model in the mortgage banking industry, which is this, I don't care the credit quality of what I'm originating, because I'm gonna sell it to somebody else. It's gonna be somebody else's problem. I don't care. And so,
But shouldn't that be also I mean, shouldn't the buyer of those things be also responsible for what he's buying? In caveat emptor, why are you buying that junk?
Caveat emptor.
Caveat emptor, that's the whole concept.
I think I went to school with that guy.
Caveat
He was
emptor.
like a Turkish guy? No, I don't. Yeah, but I mean, isn't that why the government exists, to protect people from themselves?
No, that's not, but that's a
I
political.
think that's what, I
class.
thought that's why.
No, it says it's a minimal state.
So do you agree with getting rid of Dodd-Frank?
Well, first of all, do I think Dodd-Frank just sort of goes away? I don't think it sort of goes away, okay? It doesn't go away. Yeah, look, Kwesi goes back to, right? And this whole sort of continual, you regulate, people innovate, you regulate. Not all regulation and not all innovation is good. And so, you know, I'm more of a, let the markets, the government should allow the free markets to work, as opposed to the government forcing markets to work or being the biggest player in the market. And there's been a fundamental change in the last 8 years in Washington, where the government has become a bigger player in the economy, directly or indirectly. So directly by participating, by creating healthcare exchanges and all this kind of stuff, or by regulating Dodd-Frank and all that. So if you ask me, what's the Volcker rule of Dodd-Frank is essentially trying to address what Glass-Steagall had, which was to separate commercial banking activities from investment banking activities. Do I think that's bad? No, I don't. I think that's good. Why? Because time has proven that people who have a commercial banking hat don't necessarily have the same skills as people that have investment banking hats. And more important than that, if we're going to backstop the commercial banking deposits as a country, we shouldn't put those at risk like investment bankers put their equity at risk. And so, do I see certain facets of Dodd-Frank being bad? No.
So if we didn't have the FDIC, then we wouldn't have the reason to need the Glass-Steagall or something like that.
Well,
Because that's actually.
no, but unfortunately,
We're protecting one thing for another regulation that we created.
but unfortunately, no, yeah, in theory, all accurate, right? In theory, all accurate, but in practice, I mean, we've had banking failures ever since banks were created in the 1400s or whatever, in Italy, and so what happens is,
You know why they call it banks?
I don't know, enlighten me.
No, because they will go, the guy will sit in un banco, on a bench. That's the Latin word for bench. And he will sit on the bench, and they will come, they will lend money, that will be the banco, a bank.
We'll have to validate that. That will not be on the test, but I'll take a look, I'll say. Have you put that in Wikipedia?
No.
You're gonna do that now? No, you can put the phone
No,
away.
I was just gonna give you some, update. I asked my mortgage broker, they're a direct lender, and right now it's 46.55. So 46 on the front end, 55 on the back end.
It was worse than you thought, Professor.
Even worse, okay? Now, let's go back.
So I'm giving you latest information.
Okay, thank you. Let's go back to the point at hand, okay? So I don't know that it's all bad, okay? So look, there's a lot of people out there that say, yeah, let the depositor beware, let everybody do their due diligence, and only put their deposits in a financial institution where they feel comfortable, and if they fail, tough luck. But I think I don't think politically that's sustainable. The problem is at a certain point, and that's, capitalism isn't perfect, and people aren't perfect, right? If people were perfect, would we have locks on doors, you know? Would we need insurance, right? No, people make mistakes, accidents happen. And the problem is, you know, going back to all the macro benefits of financial intermediaries, right, of having a marketplace. For example, if for no other reason than having a payment mechanism, right, banks need to exist, right? The whole intermediation process, remember about maturity and liquidity, right, and risk intermediation benefits, right, that you have in having a solid intermediary. We need financial intermediaries in order to have a viable economic structure or environment. But it's not a perfect one. And because it's not a perfect one, because people are involved in it, yeah, I think if for no other reason than for political, the FDIC is not going to go away. The FDIC, government insurance of deposits, not only in US banks, but similar schemes in other countries, is not going to go away because politically it wouldn't be.
Well, because there will always be someone, a caudillo, you know, trying to protect people from
Well,
themselves.
yeah, I mean, yeah, but the people are gonna look, I mean, and we've had that sort of view in this country, which everybody looks to Washington and says, solve my problem.
Right.
And then somebody in Washington says, well, I wanna stay in power, so I'm gonna solve that person's problem. And then we just keep adding, and then that problem solved then becomes a right to the next generation, you know, and so it
What they're
goes.
trying to do in, what they're trying to pass in Italy, the prime minister, the president trying to pass to limit the terms of career politicians, or to cut the number of
Wipe
the
out the
Congress.
Senate to 1/3 of what it is right now.
Yeah.
Yeah, I mean, there's a whole bunch of, I'm not an expert in Italy, there's a whole bunch of, you know, reforms that are, you know, people are trying to, but yeah, I mean, we've tried to do term limits in this country and they exist in certain jurisdictions, you know, so, let me talk about commercial mortgages for a second.
What Daniela was saying before, though, it makes a lot of sense. If the citizens of this country are gonna back, you know, deposits, then we should have say-so about how you proceed as a business.
Oh, no,
You know,
no,
Dodd-Frank and Glass.
well, but that's why I'm saying, if we need to do that, I think we need to do that. Then there have to be, you know, there has to be regulatory oversight.
Right.
You know, there have to be divisions of, yeah, I'm all for that. I'm not, you know, and as much as I don't want the government involved, I don't want, my personal view is, and I'm not a libertarian in that classic sense, and I'm not so much one of, you know, government stays totally out of our lives, but the government needs to create the framework where people can work in the most efficient and fair, you know, respectful manner. You know, and there are imperfections, I recognize that. That's why, no, I don't think all of Dodd-Frank should go away. You know, I don't think the Glass-Steagall, there's a reason why there's an FDI. Listen, there was a depression in this country, there was a regulation as a result of that, right? And there's you know, the SEC, the Securities Exchange Act 33 requiring public filings, and the 34, the ongoing filings, etc. Let's talk about commercial mortgages for a second. The single, and we talked about this the other day, the single biggest difference that exists between residential loans and commercial loans is that commercial loans, by and large, Ben, are,
Commercial loans,
yeah, are
commercially based.
non-recourse.
Oh,
You knew that, didn't you?
I did know that. I didn't know that's where you were going with the.
You even presented that in the class. You did, okay. All right, so the single biggest difference that exists, so, you know.
Oh, wait a minute, you know, the non-recourse, that's for stabilized assets, right? I mean, wouldn't development of a new building be
Well,
considered commercial?
again, in a seasoned environment, right, so construction loans are not,
Non-recourse.
yeah, they're typically non-recourse, we've talked about that, they're typically short-term, they're typically variable rate, they are typically non-amortizing, and they typically have interest reserves built into them, okay? Because again, there's no cash flow being generated. So yes, I'm gonna compare, you know, a seasoned asset with a house, okay? There's a whole other issue that we've talked about, which is prepayment risk, right? So what happens if you are a lender and you loan money at 8%? I'm a life insurance company, I made a mortgage to you for 8%, interest rates go down to 6%. What is gonna happen in that scenario?
Refinance.
All right, so somebody's gonna go and say, hey,
Pay
I don't
off.
wanna pay you 8%, I'm gonna pay him 6%.
So,
So now I go borrow money from him and I pay you. And now you were getting 8%, how much are you getting now?
yes.
With that money, now you gotta go reinvest it. The market rate's gone down to 6%, so you're only getting 6%.
Built-in prepayment penalty.
And but let's kind of conceptually go back to, and so why is that a problem for you?
Because now, the money came back too early and you have to find it.
So you've got a matching issue now.
Right.
So you've matched either certain deposits or certain maturities with certain terms or with certain rates. And now you've got this whole mismatch. Interest being the biggest problem, but timing is also a problem, okay? You're a life company, you're looking out 20 years from now. You know, all of a sudden now you got the money, what's a hot potato? I don't want it, what do I do with it?
Find another vehicle.
Right, but now the vehicle, that's why it all points back to interest rates. And I got the hot potato, and I got to reinvest it again, but I can only get 6%. But I promised some guy, because I sold a whole life policy, and or, you know, I'm promising him a certain return on his premium, so I can't meet it, right? So banks require, so we talked about callability, right? Callability was the right to what?
Call back
An instrument or repay it early, right? So callability is the ability for the borrower to repay an instrument early. So I'm going to introduce the concept. So lender said, hey, we need call protection to protect against prepayment risk. And in the commercial space, and let's talk about the commercial space, that comes in 3 or 4 fashions or manners. First and foremost, or primary, is you can have a simple lockout period. What's a lockout period?
A period of time in which you can't pay it back.
You cannot prepay. You cannot prepay. So, and in today's, my personal experience in today's environment, you're going to go and get long-term financing on a commercial mortgage, you're probably going to be locked out for a couple of years if you're going fixed rate. So you buy the asset, you own it for 2 years. Can't get out.
Sorry, you need long-term capital gains anyway.
Well, listen, ideally, you don't buy an asset that is core in nature, right, that you're going to finance for the long term if you have the vision to sell it in 2 years. But again, going back to some of the illiquid components of real estate, sometimes you can't sell it. You're just locked out. So that's the first sort of line of defense. Okay, you're going to guarantee me that for a couple of years. You may have some very simple and in a very primary environment, you may have some prepayment penalties. Okay? So they'll probably be in addition to, but it could be in lieu of, okay? So you may have some prepayment penalties. Those prepayment penalties come in a way of, well, you're going to pay me, 6 months, or you're going to pay me X amount, okay, if you prepay within a certain period, okay? So don't see these that much, okay? In some commercial loans, you might see some of that. Commercial bank loans, you may see some of that, but what you really have are 2 more sophisticated methods. I wish Danilo was here because he was asking. The first one is called yield maintenance. And what's yield maintenance? We read? What's yield maintenance? Okay, yield maintenance is you're going to essentially guarantee the percentage return that the lender is getting. Okay, so, I borrowed money from you at 8. When I'm repaying you, the market rate is 6. At the time that I prepay you, I am going to prepay you that 2% spread for the balance of the term of the loan. So there's a cost out of pocket at the time that I prepay to guarantee to you the return that you were going to have. Relatively simple to do. That's not where we're at today with most deals either. Now, most deals we've gone to a further iteration which addresses. So this addresses dollars, but it doesn't address the hot potato of term. Okay? We have another one which is called defeasance.
Defeasance clause, huh?
So defeasance is what?
As long as you, meet the terms, they can't call it, or?
Defeasance, if here you're guaranteeing the percentage return, here you're guaranteeing the cash flow that you contracted with the lender. So how do I do that? How do I do that? So what you do is at the time of closing, you create a trust. Okay, and you fund into the trust.
Is it escrow?
It's a trust. Okay, it's a trust, so it's locked, so it's like escrow, but it's a trust. You create an entity, and into that entity, you fund X amount. That X amount goes out and buys strips that match the payment structure that you had originally contracted with your borrower, or with your lender, I'm sorry, with your lender. And in that trust, every month, as this matures and it gets money, it makes a payment to the lender. You came in late. That's a problem.
So
Strips are
New York
separate trading of registered interest and principal securities. Whoa. Okay, does this make sense? No, you guys are looking at me like, what's he talking about? Noah, can you tell him?
Strip.
It's almost like, I'm going to say, it's an arbitrage across seas. You purchase the strips.
Yeah, so it's not so much an arbitrage, but you're creating a company, you create an entity. So you owe $30 million, okay? Okay, you owe $30 million. You have $30 million outstanding at 10%, and there's still, 12 years left, okay? There's a payment associated with that, assuming let's assume for a second it was self-amortizing. There's a payment associated with that, right? It's just a number. You had to pay $150,000 a month. I don't know if that number's right, I just made it up, okay? If you get your calculator, you can figure out what the amount is, okay? So, instead of paying $30 million to the borrower, to the lender, instead of paying $30 million to the lender at closing, you defease the loan. What does that mean? You create this trust, and you fund into the trust enough money to go out there and buy strips, a strip for $150,000 that matures in month 1. Enough money to buy a strip that matures in month 2. And so on down the line for all the number of remaining, 100 and whatever number of payments you got left. Does that make sense?
Yeah.
And this is where commercial mortgages are today, gentlemen and ladies. Sorry, I'm used to talking to boys and teens, so that's where we are. So you're essentially at the time, in exchange for a fixed term and a fixed rate commercial mortgage, you're going to have to essentially guarantee that cash flow to the lender.
Do you mind spelling that word,
I don't know how to spell it.
Look at them up.
Look at defeasance, Defeasance. It's in the book.
Okay.
So defeasance is a strip?
Defeasance. You came in late.
I know, sorry.
I said, Danilo should be here.
It's a clause written in the mortgage, is that correct?
Absolutely, it's a provision. It is called protection for the lender to protect him against prepayment risk. So you're going to guarantee his cash flow. How are you going to guarantee his cash flow? You're going to create a trust, and you're going to fund into the trust enough money to buy strips that are going to,
Pay the cash flow.
The lender.
the,
The defeasance.
the obligations that you had under the mortgage. So you're not prepaying him. You're creating, and there's a company called like Defeasance R Us or something like, there's a couple of companies that do this. And they'll go out, it's very simple, it's very sophisticated. That's why I'm telling you, the breadth of the markets and the importance of the strips. You want to defease a loan, you'll contract them, and for a fee, they'll go out there, they'll identify the strips, they'll get an audit firm to come in and certify that those strips in fact meet the cash flow, and at closing then, you fund, and then they create the trust, they buy the strips, and then they manage this entity. And as the money's collected, they pay the lender.
Do they always buy strips?
Always, because they have to be guaranteed. You're guaranteeing the cash flow. Why do you use strips? They're risk-free. See how it all comes together?
The treasury is involved in it.
How much do they fund, how much do they
Oh,
fund
in
trusts?
bonds?
Yeah.
They fund as much as is needed to buy all these strips.
So it'll be an expensive loan.
Well,
Could you do it again on the blackboard and show them when you made a 10-year treasury? And
Yeah.
it makes
so
sense
that-
when they
yeah.
saw, when you look at that.
yeah, so what happens is, okay, somebody pull out their calculator, please, and tell me.
But I see
Somebody pull out their
what you're
calculator.
saying, it's a lot of money.
Yeah.
You gotta put a lot of
Well,
money in that
hold
trust.
on. Well,
Why not just buy the property cash?
no, guys. So one of the things that I didn't mention, right? So hold on a second. We talked about this before. Treasuries can be coupon, or they can be zero coupon, right? And essentially, when you buy a strip, when you buy a strip, when you buy a strip, it's a zero coupon. Because by definition, the strip only makes one payment. And so you're going to buy that at a discount.
You're buying the cash flow.
You're not buying cash flow. You're buying a principal payment, a future value at some point. Okay? And so what happens